Assalamualaikum warahmatullahi wabarakatuh. My name is Shahrul Fahmi bin SIDEK and I am from class KBA 242TB. Today I'm going to discuss about the currency futures and option. So for introduction, we're going to look to an overview of this topic, which is we're going to look to the introduction, derivative market. We're going to look to currency futures and option, hedging and speculating, and then we're gonna make a conclusion for this topic. So as a general, the derivative market is referred to the financial contract that link to the expected future price movement of the underlying asset. It has been used as a tool for hedging, speculating, and arbitraging. So now we move to the derivative market. So first thing first, we're gonna look to the who is the participant of the derivative market. Derivative market consists of hedgers, speculators, arbitrageurs, and margin traders. And how the derivative market operates. A derivative market is set between two or more parties that derive their value from an underlying asset or group of asset or benchmark. And the type of derivative market is futures contract, forward contract, options, and swaps. As you can see on the slide, this is some of example of derivative market asset. We have stock, we have currency, we have interest rate, we have bond, we have market indices, and we have commodities. Alright, so now we move to the currency futures. So it's referred to the contract or agreement to buy or sell specific underlying asset at specific price and at the settlement price. So speculators make their profit or loss based on price changes or price movement in the future contracts, and it involves of long position and short position. Alright, now we move to the difference between long position and short position under the futures contract. Alright, so for the long position, the traders will buy the contract today at lower price and then sell it later at higher price before maturity dates. For the short position, the buyer will selling the contract at the higher price today and buy it later at the lower price with expectation that the price will fall. So now we move to the currency forward market. It refers to contract to buy or sell specific underlying asset at the specific future date and at predetermined price agreed by the seller and the buyer. So it's mean both party, and it is privately negotiated between the buyer and the seller. Now we're gonna look one by one what is the differences between the forward and the futures contract. So for the futures contract, it has a standardized contract. Meanwhile, for forward contract, it is specific contract adapted to meet specific needs. For futures contract, it has a standardized delivery date. Meanwhile, for forward contract, it can be delivered at any time. So for futures contract also, it has a daily price range. Meanwhile, for the forward contract, it has no daily limit price transaction. For futures contract, it is trade on an exchange rate. Meanwhile, for forward contract, it is negotiated directly between the bank and the customer. And in terms of the credit rates, for future contract, the credit rate is low. Meanwhile, for the forward contract, the credit risk is in high risk because since one party may not fulfill the contract obligation. So for futures contract, it is based on brokerage fees. Meanwhile, for the forward contract, it is based on the bid-ask spread. Now we're gonna look to the differences between futures and option. For futures, it gives the buyer's obligation to buy or sell the contract. Meanwhile, for option, it gives the buyer right but not the obligation to buy or sell the asset or the contract. For futures contract, it preferred by speculators and arbitrageurs. for option, it just prefers by the hedgers. And in terms of the profit, for the futures contract, it is an unlimited profit but loss potential. It means it's exposed to the loss. But for the option contract, it is unlimited profit also but limited loss potential. For the high risk, for the futures contract, it is high risk involved. Meanwhile, for the option, it is limited to the premium amount. And now we're gonna look how futures and option are used for speculating and hedging in the forex market. For futures for hedging, the futures can be used to hedge the changes or the price movement of the price in the market. It is to reduce or stop losses from the exposure of adverse price changes rather than speculating. For example, a farmer can use the future contract to lock in a certain price for their harvest in the futures. So for option hedging is being used to reduce risk at reasonable cost and transfer the risk to the sellers using premium, and the stock are sold at a specific price within specific time using put option. For futures for speculation, it allows the trader to speculate the direction of the contract price movement, which is buy a future contract and trade an original contract price and seeks for the profit for after the expiration date. And it has the long position, which is buy the contract today at the lower price and then sell it at a higher price before maturity. And for short position, the traders usually will sell the contract today at a higher price and buy it back at a lower price. For example, food processing companies buy the future contract to ensure themselves against price increases. Now we move to the option for speculation. Basically, options are monetary derivative that give the right to the holder to buy or sell the asset at a specific price and at a specific time or period. Purchasing a call option allows the speculator to bet that the price of the underlying asset will rise. In the other hand, the traders also purchasing a put option that allows them to bet that the price of the underlying asset will fall. Alright, so now we're gonna look to the currency option. So basically, currency option is a derivative securities and it provides the holder the right but not the obligation, and this can be defined also as a right to buy or sell a fixed amount of foreign currency at the specific period and at the specific price. Under the currency option also, we have two types of option. We have which is the call option and the put option. So for the call option, it's the option that gives the buyer right to buy a foreign currency at a specific period within the at a specific price within specific period, and the traders usually will buy the exchange rate when the exchange rate will rise. And for put option, it is the option that gives the buyers right to sell the foreign currency at a specific price within specific period, and usually under the put option, traders will buy when the exchange rate will fall. So what we can conclude here is the derivative is very important to maintain the efficiency of the financial market. And you know, the risk of losing money due to negative changes in the market value of the underlying asset can be avoided when the traders or the investors using the hedging and speculating for the option and the futures contract. Therefore, we can say that when you have the knowledge in order to speculate and in order to hedging the contract, you have the higher chance to get the profit and not the loss and get the loss.